What's going on, everybody? Liam O'Reilly, Vermont economic realtor. Hope you're doing well. Wanted to talk today about the jobs report, the mortgage market, and the real estate housing market here in America, and how these three are interacting with each other. If you haven't heard, the jobs market came in on Friday and was way higher than expected. We added way more jobs to the U.S. economy than we were expecting, more than doubled the consensus among leading economists, and we added around 500,000 new jobs just in January alone. So, and as a result, we've seen mortgage rates tick up. So, what's going on? Why have we added more jobs, or why do I think we've added more jobs? What's going on, and uh, why are mortgage rates increasing, and how is this going to affect the overall real estate market? Let's get right into it here. So, this is the Bureau of Labor Statistics website. If we look here, establishment survey data, total non-farm payroll rose by 515,000 in January compared to an average of 400,000 in 2022. And then this is really what I wanted to highlight. The leisure and hospitality section added 128,000 jobs in January compared to an average of 89,000 per month in 2022. So what's going on there? Well, what I think is happening, if we look at I mentioned this graph in other videos. This is the consumer loans, credit card and other revolving plans, all commercial banks. So we've seen commercial or credit card loans and revolving lines of credit increase drastically and increase faster than we've seen over the past 10 years, let's say, maybe even a little longer. So Americans are taking out more loans than they were before. And in my opinion, they're struggling to pay their bills because of inflation. So during the pandemic, when the government shut down restaurants and businesses and we were all in lockdown, a lot of restaurants couldn't work. A lot of restaurant employees weren't working at that time. And when the government stimulated the economy and the Federal Reserve dropped interest rates and started an extreme quantitative easing process that just pumped money into the system, businesses had more money to spend, and employees that were working at restaurants now had other opportunities where they could go to because employees were in demand. Now, as rates are rising, as credit card debt is exploding and inflation is taking its toll on the average American consumer, I think that my hypothesis, this is just my interpretation, my thoughts when I look at this data, is that it's possible that people are deciding to go in and work more restaurant jobs, work more entry-level jobs, to work more hours, to make more money, to help sustain the lifestyle that they've become accustomed to. If you remember Lael Brainer's speech from a couple weeks ago, the vice chair of the Federal Reserve, she said that average hours worked were declining, which is a sign of companies starting to cut back on their spending, right? Payroll is a big expense for companies. And so if you don't want to lay employees off, another way you can save money is by having them work less hours. There's a lot of hourly employees in America. Now, with this new data, we've seen hours worked tick back up. And so what I think is going on when we have credit card debt through the roof, and these revolving lines of credit that are really high and inflation being really high, is the average American consumer can't afford to have the lifestyle that they want to have. They're starting to max out their credit cards, or maybe not even maxing out their credit cards, but they just need more money. And so they're starting to work at places like restaurants and these hospitality jobs, which were the leader in jobs added in January. So I think that's at least part of the reason what's going on with the jobs report. Now, how does that impact mortgage rates? Well, the mortgage market and the rate market, the treasury market, they're trying to get ahead of the Federal Reserve. And this is good news for economic data, which means the Federal Reserve is going to see this potentially as a green light to continue to hike rates. So if we look at the NEFQ mortgage rates, this is just right on New England Federal Credit Union's website, just a local Vermont credit union. We see the 30-year fixed rate is at 6% right now, which when I checked on Friday, the 30-year fixed rate was at 5.75%. So rates have gone up about 0.25% over the weekend, and they were steadily dropping from, I guess probably since the start of the new year. Um, and the last I saw was 5.75%. Basically, all last week they were at 5.85%. So what I think is going on is people are seeing this employment data, this positive employment data that shows that the economy is strong and not slowing down as much as the Federal Reserve wants it to, and are predicting that the Federal Reserve is going to have another rate hike in March, and maybe more rate hikes than they were already baking in to their formula, to the terminus rate, to where the Federal Reserve is going to cap off with their Fed funds rate. And so that's why mortgage rates increased. Now, how does this affect the housing market, the home buying market in particular? Um, Actually, let's start with the rental market. How I think this is going to affect the rental market is, as rates rise, and what the Federal Reserve is doing by raising rates, they're trying to slow down inflation in the housing industry, but a, a I mean, across the economy, but also in the housing industry. And a big portion of what they use to judge inflation in the housing industry are rents, actual rents, and then owner's equivalent rents. Now, when rates are higher, that makes home buying less affordable, which means more home buyers, would be home buyers, have to rent, which drives up the rental market. At the same time, it makes it harder for builders to add new supply to the market because it's more expensive to borrow money to build your products, which makes things riskier. There's less of a guarantee. When rates aren't stable and rates start to tick back up like they are now, there's less of a guarantee that if you're going to build a new construction product to sell, that buyer will be there at the end. So, in my opinion, higher rates and higher mortgage rates make it so that we might actually see more inflation in the housing sector, at least as far as rents go, than we would if there were lower rates. Um, Now, how does this affect the home buying market? We are entering a time of, there's low inventory now, but we're entering a time of what should be more supply. People like to sell their homes in the spring, right? It's about 6:30 right now. If you look behind me, that's a window. It's completely dark outside. In the summer, it would be completely light. You can show your home for more hours during the day. People can get off of work and come take a look at your home. There's more buyers out there. There's more sellers who prefer the spring. They don't want people, if you're in the north or northeast like I am here in Vermont, sellers don't want buyers trucking through their house and getting it all snowy and dirty. And if sellers have kids in the school system, they ideally don't want to take them out of school mid-year. It would be great if they could wait until the spring, list their home, sell it in the spring, buy a new place in the summer, and have their kids into a new school system, and everything's all fine and dandy, and they don't have to switch things up mid-school year. So we should be seeing, and this is the case across the country. I mean, just the way the real estate market goes, it's busier. It tends to be busier in the spring and summer than it is in the winter. Right now is the slowest time of year. So as more listings are coming to the market, if we are in a time of rising rates, instead of rates have been falling consistently from their highs in the fall, if rates start to hike back up and we start to see, perceived better economic data, like this jobs report, that will signal to the Federal Reserve that they should keep hiking rates, and we see mortgage rates start to rise as inventory is increasing. This could be a time where we see sales stall and prices come back down. I mean, we've seen prices drop in major cities across the country. We haven't seen it yet here in Vermont, and there's markets in the Northeast and across the country that are holding strong. But I think if the Federal Reserve keeps raising rates, if mortgage rates keep rising, especially as we move into spring, which is a time of high inventory, that is where we could see prices really start to fall, and the market really shift, even without new supply coming to the market, because there's not going to be a whole lot of new supply coming to the market as far as new construction goes. It's just going to be motivated sellers selling to motivated buyers, which is going to cause the market to freeze. And if there's more motivated sellers than there are motivated buyers in a period of high interest rates, then we're going to see prices come down, and you will see prices come down in your local market. This is a tricky time to buy, tricky time to sell. So if you're looking to buy or sell, you really, and you want somebody who knows what they're doing, if you're here in Vermont, I would be happy to help you out. All my contact information is listed in the description. If you are looking to buy or sell in another state, let me know. I'd be happy to call around, find you a great realtor who knows what they're doing so you are in the best hands. Other than that, let me know what you think about this video. Let me know what you think about my thoughts on the labor market. That's kind of what I saw in the data and my theory about what's going on. But I would love to know your thoughts. Leave a comment on this video. That'd be great. And I will see you guys in the next video.